I'm telling you, this time is different. I've never seen, insert some fact or figure here, before in my life. I wouldn't advise people to buy the dip this time because we may never recover from, insert name of latest tragedy or crisis here. So, the stock market has finally begun to respond to the coronavirus situation, as we were all expecting it to at some point. The S&P 500 just saw its biggest two-day drop since August of 2015. So, naturally, the panicked articles and other news stories speculating on the future of the stock market are beginning to arrive in droves. And if you've been investing for any real length of time, you've probably heard quotes in the vein of what I said to open this video. The fact that you shouldn't be buying the dip yet, or even at all in some cases, because whoever the speaker is has some reasons as to why they think this time is different and the markets may never recover. Sure, eventually one of them may turn out to be right. But at least thus far, the market has recovered from every single scare it's ever faced. And given that we were seeing all-time record highs being set as recently as a few weeks ago, I think it's safe to say that the markets have, by and large, thrived despite all of those scares. And at least at this point in time, I don't personally think there's any reason to believe it'll be any different this time. Yes, the coronavirus will have an effect on the economy, and by extension, our investments, in the short term. And yes, those effects will probably be more than just the losses we saw to open this past week as we try to get a handle on containing the spread of the virus. But I don't think that means that we should suddenly sell our investments, or even stop investing from month to month. Today, I'm going to be discussing why by revisiting an old topic on this channel, the history of stock market crashes and what we should be doing during them. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. So like I said, this past Monday and Tuesday was the worst two-day stretch for the S&P 500 since at least August of 2015. But that on its own doesn't mean very much. Why? Because the markets are always relatively volatile. It comes with the territory, and a couple of days of 3% drops can, and have, been quickly made up for in the past. Let's look back at August 2015 to see what I mean. The two-day stretch I'm referring to was from August 20th, 2015 to August 24th, 2015. There was obviously a weekend in between the dates. The S&P 500 closed at $2,035.73 on August 20th. It fell all the way to $1,893.21 by the 24th. That's about a 7% drop over the course of 2 days worth of trading, and it would fall even further to $1,867.61 the very next day. That's not a good stretch of days to be sure, but do you know what happened right after that shock? The market started to rebound. Slowly but surely, it climbed its way all the way back up to where it started from and beyond. And guess how long it took? 2 months. Almost to the day. On October 22nd, 2015, the S&P 500 closed at $2,052.51. And over the next 4 years and change, it would rise to over $3,000. Now, that's not to suggest that every single shock recovers that quickly, or that every single shock goes on to grow that rapidly after the recovery, because of course that isn't the case. But what it does illustrate is that these sudden downturns, no matter how severe, are not the end of the world. So I can't predict how long it'll take us to figure out what's going on with the coronavirus and put a lid on its spread around the globe. But as an investor, I can take a practical look at the potential outcomes of the situation. And the way I see it, based on the data we have now, from an investing perspective, there are 3 primary ways this thing could go. First, it turns out that the coronavirus is too much for us in our medical technology, and it eventually wipes us all out. Or at least that it wipes enough of us out that our way of life is irreparably altered to the point that we don't see our investments recover in our lifetimes. But again, based on the numbers that I've seen anyway to this point and the history of prior disease outbreaks, I don't see this as the most likely outcome. I also know that if it does come to this, then we're going to have far more to worry about than our investment portfolios. So the fact that we lost the money in the markets really isn't going to matter much at that point. Second, the disease spreads very quickly around the globe, infecting millions of people over multiple years and causing massive economic slowdowns. After that stretch, we finally managed to get a handle on it, and slowly, over yet more years, the markets begin to recover. And of course, third, the disease spreads, but we managed to get a handle on it relatively quickly, and the market crashes, sudden and severe like we've been seeing this week, but we do recover from it within a few years. And maybe it's just the optimist in me, but I think the most likely answer is that third option. I do think we're going to see some slowdowns from this outbreak as medical professionals are working on figuring out how to help people recover and stop it from spreading, and I do think that it'll take some time to recover from it economically once people are healthy again, but I don't think this is the start of the next Great Depression. With that being said, that's all the opinion of some random guy on the internet with no medical training or a crystal ball. So let's take a look back at the history of the stock market to see how it generally responds to these sudden panics, and also see what we can do to make the best of the situation, whichever way it ends up going. So before this most recent drop, there have been 337 separate days where the S&P 500 has dropped by at least 3% from the prior day's close since 1928. That may sound like a lot, but keep in mind that's 337 days out of a possible set of 33,000 some days. But if we took a look at what happened after each of those 337 days, what might we find? Well, I did take a look at each of them to see how the market fared after a week, a month, a quarter, a year, 3 years, 5 years, and 10 years. I did this to get an idea of how drastically the market shifted over the very short term as well as over the longer term, and here's what I found. 1 week following a sudden 3% drop in the market, the average return was actually a positive 0.41%. This suggests that the recovery had actually already started. The median returns bring similar suggestions with a 0.82% weekly return. Sure, this does mean we don't typically see full recoveries from this kind of a sudden drop in the span of a single week, but the fact that more often than not the results are at least positive is good to know. After a month, the average and median returns were 0.6% and 0.79% respectively. 3 months down the road, the typical returns rise to an average of 2.99% and a median of 2.07%. Still not fully recovered in either case, but generally on the mend. A year after the 3% single-day drop, the market has, on average, grown by 9.2%. The median return is a little less eye-popping at 7.25%, but both suggest that a normal outcome in a normal situation following a sudden 3% drop is a recovery that takes about a year or maybe a little less. But those are typical scenarios. What about the ones that are either really, really bad or really good? Well, we've had quite a few of those in the past as well. The worst single-week return occurred in October of 2008, as you'd imagine. On October 2nd, the S&P 500 closed at about $1,114. A week later, it was down to just $909. That's a loss of over 18% in the span of a single week. The worst single-month loss occurred in October 1929, when the S&P 500 fell from $27.73 a share to $21.27 for a price loss of over 30% in a month. Starting in March 1932, the S&P 500 fell from $7.58 to a mere $4.44 a share over the span of a single quarter. That's a 41% loss. And of course, the Great Depression also claims the worst one-year stretch in the history of the stock market with a 68% drop happening between July 1931 and July 1932. Ironically, though, some of the best stretches also occurred during the Great Depression, with the best single-week return of nearly 26% starting in August 1932. The best monthly and yearly returns had started in July of the same year. The monthly return was 67%, and the yearly return would go on to be 169%. The best quarterly return had begun in June and reached a whopping 95%. At least that's from a purely price appreciation standpoint. If we were to actually include any dividends we got and then reinvested over that time, or any money that we continued to invest during the downturn, we'd likely see even quicker recoveries of our net worth. Or in the instances of a best-case scenario, even larger increases in our nest eggs. So let's take a look at the best and worst of the stock market's history and see what would happen if we just ignored the noise and continued to invest. As you can imagine, most of the worst experiences occurred during the early portion of the Great Depression. So this might be a little repetitive, but I think it'll illustrate the importance of staying the course as well as anything can. So here we go. For this portion of the video, we'll be assuming that John starts off with $10,000 already invested in the market. We'll then compare what his net worth would be during various 1, 3, 5, and 10-year time periods based on his behaviors during the crash. In the first instance, we'll have him do nothing at all. He won't sell his investments, but he also won't reinvest his dividends or invest more of his own money out of pocket. In the second scenario, we'll have him reinvest any dividends he does get, but he still won't be investing any more money out of his own pocket. And lastly, we'll have him reinvest his dividends in addition to investing $500 a month out of his own pocket. So, it's May 1929. The S&P 500 is valued at $25.66 a share. John already owns about 389 shares, which are valued at $10,000. But then the market begins to get volatile. A year later, John's investments are worth a mere $9,300. After 3 years, they've dropped to $2,150. By May 1934, his investments have recovered a little bit, but still sit at a value of $3,825. And finally, after a decade of waiting, John's investments are still worth a lot less than they were when he started. After a full decade, John's original $10,000 nest egg is worth only $4,375. Historically speaking, this is basically as bad as we've ever seen it get with the S&P 500. And since John did nothing to help his situation during the crash, he got absolutely slammed, losing nearly 80% of his entire nest egg when things got to their worst point. At least on paper, because he didn't actually ever sell any of his shares, which is good. But he could have done a lot better. Let's see what would have happened if he had just reinvested his dividends. By May 1930, a year after John's initial $10,000 investment, his net worth totals $10,800. The S&P 500 is valued at $23.94 a share, which is down from the $25.66 a share it started at. But thanks to the reinvested dividends, John now owns 452 shares, so his overall net worth grew, despite the slight drop in the price of the shares. Because the market crashed so severely, however, this wouldn't continue forever. By 1932, the nest egg would be worth only $4,175. Not good, but certainly that's much better than the previous scenario where John's investments were only worth $2,150 at this point. And because of the fact that John is buying more shares with his reinvested dividends, we're going to see that slingshot effect of the market coming out of a crash down the road. By 1934, John's net worth was technically back in the green. His nest egg had risen to $12,400, which is quite something considering that the S&P 500 share price is currently sitting at $9.81, a far cry from where it started. And in 1939, 10 years after his initial $10,000 investment, John's nest egg is now worth $36,675. He owns 3,266 shares of the S&P 500 and has seen his net worth triple despite the fact that he's been investing during the Great Depression and the market itself still technically hasn't recovered. At this point in time, the S&P 500 is valued at $11.23 a share. That's still quite a long way off of where it started, and way, way off of where it is today. If we were to look forward in John's future to December 1952, when the market itself finally fully recovered and set a new all-time high of $26.04 a share, we'd see that John's nest egg would be worth about $1.9 million. And that's without investing any more money out of pocket. If John had invested money out of pocket, in addition to the reinvesting of his dividends, the outcomes would have been even more incredible. Hypothetically, if he had invested $500 a month, his net worth would have been $17,475 after 1 year, $13,525 after 3 years, $58,000 after 5 years, $219,500 after 10 years, and get this, $12,580,743.14 by December 1952. So I've said it before, and I'll no doubt say it again in the future because it's important to remind ourselves of this, especially in the moment. But from an investor's perspective, stock market crashes are not a bad thing. They can bring with them many other bad events, such as a job loss or, in the case of the coronavirus, possible illness or even death. So it is very, very important for us to protect ourselves. And obviously we do this financially by having a fully funded emergency fund at all times, keeping our burn rate as low as reasonably possible, and not over-leveraging ourselves with debt. But unless you're in a situation where you absolutely have to, Try to avoid selling your investments. Your future self will almost certainly thank you. And if you want to learn more about the history of stock market crashes, you can check out the playlist that should be appearing on your screen right about now. I know today we were more focused on what happens after sudden shocks to the system, but the other videos in that playlist will give you a little more of a broad view of stock market crashes. They do talk about some of the things that we discussed here today, but also things like how long do stock market crashes of all kinds generally last. So if you're interested, be sure to check that out, or if you want to learn more about investing in general, you can check out my investing playlist, which should also be appearing on your screen right about now. But that'll just about do it for me. Thanks for watching, and have a great day.